Today, folks, history doesn't repeat, but it sure as hell rhymes as we dive into these 5 recession-proof dividend stocks that are not only doing ridiculously well, most of them are sitting at their all-time highs in this very moment. And then we're going to comprise it all into my favorite dividend ETF that takes all of us into one simple fashion for you. And finally, we'll talk a little bit about tech earnings, as I've been doing exceptionally well in this market environment because I've been dodging bullets. I mean, that's half the game right now, is just trying not to get slaughtered. Pigs get sent to slaughter, baby. And I got lucky selling out of TSM when I did. A lot of criticism from there, but their earnings were deteriorating. I said, nope, not going to do it. I thought they'd be doing better. I sold out of most of it before earnings, the rest of it after earnings. It just keeps going down. Not that it'll continue like that in the future, but this is a scary market, man. It's hard to wrap your head around the reality of what is a good investment. And yet you can always just come back to that fundamental truth of these recession-proof dividend stocks. They have been since the beginning of most people's recollection of the market, and they continue to be. I mean, look at McDonald's. Damn it, this thing's up 10% year to date. In 5 years, it's up 83.25%. I mean, I don't understand the value around it. Never been able to wrap my head because most of it's based on the real estate. It's not like their growth vectors are absurd or obscene by anything. Any crazy metrics going from 77 cents, quarterly dividend 10 years ago today, about $1.52, just getting to the doubling, barely doubling the dividend there. And you can take a look because a lot of people are saying, hey, McDonald's customers are still loving it despite the price hikes. And I'm not. Man, did I ever give up on McDonald's. And when it comes to McDonald's and their earnings, crushing it because people still love to overpay for coffee and overpay for their value menu. I mean, I used to go to McDonald's. I'd get a junior chicken. I'd get usually a coffee or a McFlurry, and it'd always be under $5. Can't do that anymore, and I purely stopped going. I became more like Graham Stephan. I hate Starbucks unless I got a coupon or a gift card for it, and I make my coffee at home now because I don't know who's going out and loving paying these exuberated premiums. My fiance's father even said, hey, like if you're gonna go buy a coffee out, you should just go buy the Keurig pods and you can make fancy coffee at home for the same price if you're just gonna waste your money on it, because it's still a little cheaper even to use Keurig. But nonetheless, they're crushing it. So this is still proving to be recession proof. People love their overpriced McDonald's crap food that they could make at home for a quarter of the price. But hey, that's just my opinion. I'd love to know what you think. But getting into the other crap that'll give you diabetes, Coca-Cola. This takes me back to the early days of investing, because I always remember I got on the phone with Kevin O'Leary when he was on BNN. I actually got to call into their live show. I said, what do you think of Coke? And he's like, oh, sugar, not going to be popular in the future. That's a horrible Kevin O'Leary accent. But nonetheless, he was wrong. Coca-Cola has been crushing it. People love their sugary drinks. And this thing 5 years is up 47.38%. And year to date is starting to pressure back into its all-time highs. These stocks are now outpacing the S&P 500, which is kind of neat to think about. And Coca-Cola's dividend not nearly as resilient. 28 cents 10 years ago, 46 cents, 10 years later. Nothing too crazy. Their earnings doing exceptionally well. Again, these are companies that are able to price control their products. I mean, we keep talking about pricing power ETFs like Meet Kevin, who doesn't understand pricing power, because these are the companies that have pricing power, things that people physically need, food, products, things that most people go out. I would honestly say Coca-Cola is a bit of a luxury. I don't drink it. I've become a sparkling water man myself, not to Andrew Tate my life here, but it gives me all the same feels with none of the disgusting, stomach aches after the fact. This is an interesting video, man, but let's continue on with the competitor PepsiCo, my preferable favorite, because if there's one junk food I can't get away from, it's got to be Doritos, though I have stopped buying them. I do like Takis. Takis are like these new things that really took off. I don't think they're a Pepsi branded product, but nonetheless, when there's Doritos around, I'm eating them. Doritos are like a childhood just memory that I can never just walk away from. But this thing's crushing it, up 86% year to date, pressuring its all-time highs, up 5.5%. It's nice when this thing's kicking over a 3% yield. If you can capture a 3% yield on this when the dips happen, it's a great buying opportunity. Always has been and proves to be. 54 cents 10 years ago on a quarterly dividend, today at $1.15. So definitely doubling of the dividend, proving insanely resilient here. Pepsi posting some pretty good results here, again, because they have pricing power. People love these products. $1.50 basically adjusted versus the $1.39 expected on their EPS. Revenue $17.8 billion versus 17.2. Pepsi, if I had to pick Coke or Pepsi, I don't know why Buffett loves this Coke. I would surprised he just didn't pair it with Pepsi. Buy some shares in this company too. But let's talk about the backside of our bodies. Poop, toilet paper, the things we definitely need. Procter Gamble here has been one that I've followed resiliently, and was one of my biggest regrets when I sold it years ago. I captured this when I was paying a 3% yield. I don't even know how many years ago. It was like one of the earliest day stocks I would have bought somewhere back here, and I should have never sold it. Yeah, I'm in and out of stocks. I'm weird, flaky. It's why I'm mostly focused on indexes at this point because I'm terrified of the volatility of this market. I don't know who's coming or who's going, but these companies are pretty standout-ish. Again, trading at a pretty hefty premium here, and taking a look at the dividend growth is again not that stellar. 56 cents 10 years ago quarterly. 94 cents today again, but you pair all these companies together, you're doing pretty good this year if you're more like a Ray Dalio. These are like Ray Dalio kind of stocks. You ever look at Ray Dalio's portfolio? He's really into these kind of companies, right? And Procter Gamble, again, posting some pretty good numbers. I mean, nothing crazy. Net sales were up 4%. EPS diluted $1.37 versus $1.32. So again, these companies are all coming in line, proving that our entire inflation is being made off the backbones of these companies. These companies are making more money than ever, even though inflation's out of control. I think they're using inflation at this point as a tool to make themselves ever more richer, because God knows they're not going to bring these prices down, right? Like, even though inflation's cooling off, obviously logistics are working themselves out, products aren't any more expensive to be put together, they ain't bringing those prices back down, are they? Ask McDonald's. You think they're ever going to bring their prices to hell? No. They're getting rid of all their staff at the front desk. It's all becoming robotics now. You're not benefiting the end user here, so why do you keep giving them your money? It's like funny because I can't bring myself to buy these companies because I'm starting to hate them. Kimberly Clark, man, this is another one that I find very intriguing because this one is kind of like the underdog that's coming back. It kind of reminds me of 3M, though I'm not going to talk about 3M because it's not kicking near all-time highs. But Kimberly Clark has been getting beaten into the ground. But if you were able to have the fortitude to buy some of these dips, I mean, you could have potentially seen upwards of 30% gains. Year to date, really coming back, starting to retest its all-time highs here. Very fascinating company. Dividend, 10 years ago, 78 cents a quarter. Today at about $1.18. So again, not nearly as nice as something like a Pepsi, but nonetheless, Kimberly, guys, if you've never heard of them, I mean, they're doing your huggies. They're pampering your babies. They're pampering your backsides and your nostrils and women hygiene stuff. I mean, this company, proving pretty resilient for those dividend investors that could stick by it. But honestly, for me, and I've come down to this conclusion that instead of just getting in and out of these, cost averaging into 20 different stocks like PPC Ian does, or 40 different stocks, I think his portfolio is like 40 or 50. I think it's just easier to reside in your soul to just buy something like the Schwab US Dividend Equity ETF. This is probably the best one I've come to the conclusion of. Either this or VYM. Could maybe pair both of those. VYM is pretty nice as well, but Schwab is the best performance, and right now is technically outpacing the S&P 500 just because of the wonderful yield this thing provides. Up 47% over the last 5 years. It is down 4.23% year to date, but again, you're getting over a 3.5% dividend. So I mean, it's pretty balanced here, and I got like 111,000 Canadian dollars. I'm a Canadian focused investor, but that's the conversion rate. I got about over 100K CAD invested in here, and look at the stocks. I mean, these are incredible. AbbVie. We haven't even talked about healthcare being a resilient, recession-proof investment because it's a little beyond my scope of understanding. But look at AbbVie here. I mean, this thing's up 66% over the last 5 years, pressuring its all-time highs currently. It's back here when it took some of these major dips last year, it was caking in almost like a 4.5-5% yield. You'd be crushing it if you've been buying the dips on AbbVie, right? But I really, really love this Schwab US Dividend Equity ETF. I mean, AbbVie, Pepsi, Merck & Company, another credible one there, CocaCola. I mean, these alone almost make up like 20% of this each, 20% or so of the ETF. Home Depot, we haven't had earnings yet for Home Depot, but oh my God, incredible companies. Kimberly Clark, all that's in here. You can kind of scroll through by just taking a look at the viewing of the holdings here. I mean, Lockheed Martin's in here, so you get some of those. Not the biggest fan of Altria Group, but hey, I'll take it. You got 3M, Kimberly Clark, Ford Motors, again, not one that I'm the biggest fan of, but I'll take it for now. Again, a diversified portfolio, so some of the ones that I think will underperform will be made up by some of the top weighting ones here. But nonetheless, it's a pretty resilient ETF all in all, right? And then just finally, guys, we are heading into a fascinating earnings season that will really prove that if people are still willing to pay up a premium for these consumer stapled products. I mean, obviously I'm operating on a MacBook Pro here, and I've got the last iPhone that came out. This costs more than my car between my phone and my laptop, and that's not a joke. I mean, this laptop and this phone are premium products, which is why no one's buying the new release of the MacBooks. I mean, they saw a 50% decline, and that's in orders and shipments. So that's probably why we're seeing a decline by Taiwan Semiconductors, why the earnings are starting to get a little bit deteriorated in their guidance. But Apple's going to be fun to watch because honestly, MacBooks are such a small segment. They're obviously becoming almost a bank with they're offering, interest rates on their savings, trying to get credit cards, all that stuff right now. So Apple, this is a darling. This will be a fun one to watch. I mean, you could pair Apple with any of these dividend stocks, and it is technically a resilient dividend stock. If you want some nostalgia, go watch Marquez Brownlee. He just spent $40,000 on the original iPhone that came out in 2007. Whew, if you're old, if you're a millennial, you want some nostalgia, what you were doing around this time, because I remember it, and I was still using a flip Razr phone, and I wasn't too appealed by the iPhone, but I do think I got the second generation, and in fact, I still think I have, what is this, the 5C that came out. This thing still works. I cracked the screen. I was thinking about getting a screen replacement, because you can get them for these ones still, and I mean, this is even still nostalgic. Look at how small this thing is compared to like this one that I'm using now. It's kind of wild, really. But nonetheless, I'm also going to be watching Microsoft tonight. Their earnings are coming out. I don't think Apple's is tonight, but Microsoft, we got Facebook tomorrow. Maybe I'll do a live stream of Meta's earnings because it's usually been a residual on this channel to see the Meta earnings. But I'll pass the question off to you at this point. I'd love to know what you guys think about this conversation in that comment section below.